Alright, hey everybody. How you doing? Thanks so much for coming today. My name is Steve Goulis. I'm a sophomore in Morse College. And a little bit of background about me, I'm a member of the Yale Student Investment Group, and I've done a little bit of investing on the side. And so what I'm trying to get out of this really is to learn, along with you guys, about investing as well. Welcome to our first meeting. So, just a little bit about this coming semester, the fall, and this coming spring. Today we're going to have an introduction to basic concepts of finance and investing. And in November we're going to have portfolio construction and management and economy sectors and companies. And as we go along, it's going to get more technical with more analysis. So we're going to do discounted cash flow and stuff like that, which we'll touch upon next semester. In addition, we have those speaker events on top of the education meeting, so just wanted to touch upon a few people that are interested in our group and are going to come to speak. We have Nicholas Barbers, who is a professor at the Yale School of Management, Behavioral Finance, which would be a really good perspective for our group, and that's November 18th. We have Keith Susi from Goldman Sachs, Sales and Trading. He's going to be coming December 4th. And next semester we have some guys, for example, Jeff Moore, portfolio manager at Fidelity. And we also have managing directors at Goldman Sachs, Deutsche Bank, and potentially a partner from Goldman Sachs as well that will be speaking to us next semester. So a lot of awesome opportunities for you guys. So basically, what are the goals of our first meeting? The first goal is understanding the basics of the stock market. What is a stock market? What's a stock? What's a share? And then the second part is understanding the top-down approach, which is an outline for evaluating a company, which Cam will talk about when we get to that. So the basics of the stock market, this is a pretty rudimentary picture, basically just the equations of, you plug them in. So you can start at top left corner, go to the bottom right corner. If you guys don't understand this concept, I kind of recommend maybe leaving now. But if not, then yeah, good luck, thanks. This is it. So, thanks for coming. Now I'm just screwing you guys. So basically, getting started, the two ways a company can raise money is going to be through a stock or a bond. And so, for example, let's say one of you guys had a company, right, and you're looking to raise capital. So you could actually issue a bond to me, so that'd be a corporate bond, right? And I would give you the money. And in return, I would get that money back and the benefits of an interest, which is a predetermined amount. So like 3%, 4%, whatever it might be. And another name for that interest is called the coupon. And then with the stock, basically, if you have a company, you want to raise capital, you can issue stocks to the public. So it's initial public offering, an IPO, right? And so instead of issuing a bond and getting money through a loan, you're issuing equity of your company, which is like ownership of your company, right? So if the company benefits from the growth of the economy or does well, you benefit as well. So you're getting increased stock price and you can sell it in the future. And then some companies also pay out dividends as well. And so stocks are considered equities and bonds are considered fixed income. And that's because when you have a bond, when someone issues you a bond and you pay it, you give them the loan for the money, your yield or your profit is already predetermined, so it's like fixed income. And with the stock, you have a higher upside, but also lower downside as well. So a little bit about stocks, like I mentioned, definitions, equity ownership in a company. You can buy and own it for as long as you want. So if you're dealing with bonds, after a certain amount of time, the bond will just disappear, and you'll get the original amount of money you invested and the coupon, which is that interest rate. And you can own two different types of shares. So a stock is initial public offering that a company will give to the public, and that's considered a stock. And then in that, some companies might have 31 million shares. And so if you own one share of 31 million, you own one 31 millionth% of the company. So that's considered equity or the ownership of the company. And so you either have common or preferred shares. Common, for example, give you voting rights in the company, but a preferred share usually gives out, are more expensive, but give out dividends, which is that kind of, it's like a thank you gift in a sense that the company gives you for owning a share of their stock. And so there's two ways for you to profit from owning a stock or a share of stock. And so it's the share price appreciation, right? So the stock goes up, you can sell it, you can make money, right? So you pay $5, it goes up to 20, you make $15, right? And then additionally, like I mentioned, you have the preferred shares. Some of those, some people who invest in that will receive dividends from the company. So on top of the stock price appreciation, the share price appreciation, rather, you also get additional profit through dividends. And dividends aren't required from a company to offer, so that's something that they do to kind of entice people to also, buy a share of their stock. And so advantages, like I mentioned, is higher risk, higher reward, so you're going to make more profit than a bond. However, it's more risky, right? And so that's one of the disadvantages. It's more risky, but like I said, high risk, high reward, and you could potentially lose everything, so 100% initial investment. A little bit about bonds. Basically, like I mentioned, if you have a company, I'm giving you money, right? So I'm the creditor to you, right? So I'm loaning that money to the company. And after loaning, I expect to get it back after a certain amount of time, and with that coupon, which is that interest rate, right? And so, like I said, fixed income, you're only going to get initially what you loan out, and that interest rate. And so, like I mentioned, there's different bonds. There's corporate bonds. Companies can issue bonds. The U.S. government issues bonds, and then you can also have municipality bonds. So, for example, like Chicago, the city of Chicago can issue a bond, and if they need money, right, and then people will loan them. For example, Fidelity will loan them money. And so, how do you make money from owning a bond, right? So, like I mentioned, coupon and interest rate, and you usually receive quarterly, semi-annually, and annually payments of that coupon. So, advantages: it's considered a safer investment than an equity investment. And that's a stock. And like I mentioned, low risk, low reward, and you are the first to receive compensation in the event of a bankruptcy. So if the company goes under, you're going to be the first one to get paid back. And the disadvantages: risk of default, the event the company goes under. No ownership, you don't have any voting rights. So if you had a common share, you would have a voting right in the company. And then addition, valuation analysis for bonds is a lot more complex. So just a little bit, a whole thing here is diversification, right? So you can see it's comparing the average return or the yield of a certain amount of investments and an arbitrary risk number or in percentage. And so if you go 100% bonds, you have a higher risk and a 9% return. But if you do 75% bonds, 25% stocks, you can actually diminish your risk and increase your return or your yield for profit. So let's just touch upon kind of the diversification between bonds and stock in the portfolio. And here, we just wanted to include this because had you invested about $5,000 after the Great Depression, you'd make $12.7 million today in a stock, and you would make a lot less actually in a bond. But it just shows the difference between stocks and bonds, and also the importance of investing, because you can grow your money. So what's our focus for YUDI? We're going to focus on the equity, right? So like I mentioned, that's a stock. But we're also going to touch upon the fixed income and the bonds as well. So where are you going to buy a stock, right? So there's different kind of indices. So for example, the Dow Jones Industrial Average has the 30 largest companies, and that includes Intel, Microsoft, GE, stuff like that. Then you have the S&P 500, which is the 500 largest in the United States, and that includes Apple, Dell, larger companies like that, Facebook. And then the NASDAQ Composite, it's the technology companies and growth companies, and so they're usually smaller. New York Stock Exchange contains a variety of different types, and it's really important because Wall Street, New York Stock Exchange is in New York City, so it's one of it's noted for that. And the Russell 2000, it measures the performance of small cap companies. So if we go back to the S&P 500, it's companies that with higher market cap, and market cap is basically larger companies have a higher market cap, smaller companies have a smaller market cap, right? So the S&P 500 is the 500 largest, and then Russell 2000 is usually the performance of the small cap, those smaller companies, right? And this is considered the best measure of performance of these small cap and mid cap shares of a company. And then the FTSE 100 measures the performance of the 100 largest companies, London Stock Exchange. And then the Nikkei 225, similar to the Dow Jones, it has the largest 225 stocks for the Japanese equities. And then the Hang Seng, it represents 45 companies in Hong Kong, and they're considered the main indicators of economic growth or performance in Hong Kong. And so, also with diversification, it's important to understand a little bit about international markets as well, but our main focus is going to be on the US market. So moving on, now we know what stocks are, right? We know what the potential to make money from them is, and we know where to buy them. So now we're going to see, how do you go about choosing one of the thousands and thousands that exist? So why would you just not go to the slots, right? Or just go you can sell and just invest all your money in that instead of buying stock, right? Because 1 out of 1,000, your percentage is the same. So basically, when you're investing in a stock, you're making an educated guess as to whether or not the stock is a good investment or a bad investment. And so when you go to a casino, for example, and you go to a slot machine, you have no idea if that slot's gonna rip you off or make you $5 million, right? And so that's why it's important to understand kind of the basics of this, so you're able to use your money effectively in the future. All right, Cam's gonna take it from here.
All right, guys, thanks for coming. My name's Cameron Kurzik. A little bit of background about me. I've had some financial experiences. I did an externship at Goldman Sachs in sales and trading. I did an externship in investment banking at JP Morgan, and I did a full internship in wealth management at Undergraduate management. So I've had some experience in finance, and I've been around and really interested in investments, equity research especially, and trying to find the next stock that's going to perform, beat the market, because it's the hardest thing to do. So that's what I want to do. What I want to go over today is the top-down approach. This is basically what people spend their entire careers on, trying to master. It looks very simple here, but there's so much to it. I was telling Steve and Justin, this is the inception of investing, because there's subsets inside of subsets inside of subsets inside of subsets, and it just keeps on going. And so that's why this is a very simplified picture. And the goal today is just to try to go over a brief overview of each category and how we start with the macroeconomy and can end up with an individual investment. And it's important because a lot of people feel and are discouraged to start investing or to even think about going into investing and trying to tackle it, because it's like, geez, investing, like, where do I start? It's so big. And so this is a very logical process to evaluate the company. And it also makes it a little less intimidating, so people feel like they can actually start trying to do it. So this is just a description in words of what the top-down approach is. So let's start. Starting with the macroeconomy, and we're going to work our way down all the way to individual investments. So when you're starting, you want to start investing, and where do you start? Well, you need to look at the macroeconomy and figure out, what's the future of the economy look like? Where's it going to be a year from now, 5 years from now? And the best way to do this is to look at the index of leading economic indicators. This is published every month by the Conference Board. It's a great publication, and it has everything from the unemployment rate to the S&P stock index, the money supply, and even consumer expectations. How people like you and I, how we all feel about the economy, where it's going. Other macroeconomic conditions to include that you should look at are like things like war, exchange rate, weather, if there's Hurricane Katrina, Hurricane Sandy, and even recently Ebola. If you've been following the markets at all, the markets have gotten very tense from the introduction of Ebola, and they've actually caused a contraction in the economy because people are so nervous about Ebola and the uncertainty that it causes. But analyzing the macroeconomy is really important, and it's important because it then takes you to the next stage as an indication of what sectors and asset classes are going to be attractive in the future. And so that's where we're heading next. But first, I wanted to make this clarification of what an asset class is, and the fact that we're only going to be focusing on equities in the YUDI. So an asset class is a group of securities that exhibit similar market characteristics and, more specifically and importantly, similar risk and return investment characteristics. And so each asset class is going to behave differently in any given market. So if consumer sentiment is really low, if the money supply is really low, unemployment is rising, maybe it's not the best idea to invest your money into equity at this point, and maybe you want to try to think about going into, putting more of your money into fixed income and holding some of it in cash. The three main asset classes are equity, fixed income, and cash, and anything else besides that is considered an alternative investment. For YUDI, like I said, we're going to be focusing mainly on equity. Just because, like with Wall Street Survivor, the platform is a stock trading system, so it only trades stocks and, I guess cash as well, but there's no trading of bonds. That being said, There are ETFs, and you could think of as an ETF, it's an exchange-traded fund as a bundle of stocks. It basically is, varies in range of number, but it holds, almost as an index fund of a certain amount of stocks and a certain category of stocks. So like, there are ETFs for real estate, there are ETFs for commodities, like United States Oil, USO, that's an ETF for oil. REITs for real estate, or real estate investment trusts. So you can invest in alternative investments, but through ETFs. Okay, so once you've analyzed the macroeconomy, right, and you've made predictions about where you think the economy is going to go, based off certain, based off the index of leading economic indicators, and basically, your own opinion, because in the end, it comes down to your own opinion. You could choose which sectors, based off that macroeconomic analysis, are going to be attractive in the future, which are going to provide a high return. But like I said, to mention, these are, since we're only focusing on equity, these are sectors of the stock market economy. And any economy, any developed economy, typically has around 10 to 12 sectors in the economy. The U.S. economy has 10 sectors. And so let's say, for example, you performed your macroeconomic analysis, you've made your predictions, and you think consumer staples is going to be really hot in the future because unemployment's going down, consumer sentiment is high, it's nearing Christmas time, people want to spend, the economy's booming, so you think that sector of the economy is going to do really well. So you choose on consumer staples, and this is on Fidelity.com. You could go on this right now. When you get back, you could do the same thing. But this is just an example to show, the narrowing of the evaluation process. So you choose on consumer staples, and then there are the subsets of the sectors of the economy. Subsets of sectors are industries. Each sector has a certain amount of industries. There are about 70 industries in total in the U.S. economy. Each sector has, 1 to 6 or 1 to 10 industries. They all vary. So, you've analyzed macroeconomy. You've chosen a sector that you think is going to be hot in the future. Now you got to find an industry within that sector, industry or industries that you think are going to perform well. How do you do that? That's the question. So analyzing industries, how to know which ones to choose. There are a lot of things you could do, and that's the magic question to determine which industry, which stocks is going to be hot. But Porter's 5 forces is, in my opinion, and everyone I've talked to, everyone who has knowledge in investing, they all use Porter's 5 forces to determine which industry is competitive and which industry is not competitive. And the thing is, with industries, you want to find industries that aren't reaching pure competition, because industries that are going to pure competition means that they're facing or approaching normal profits. And normal profits is zero profits. And so as the market becomes more efficient and approaches pure competition, that means they're not going to be making money. If they don't make money and you're owning the company, you're not going to make money either. So there are about 4 forces, as you can see around the outside, and this is something you should look at later on your own, just to really get a good grasp of it, because it's really important. But just to introduce it briefly, there are bargaining power of suppliers, threat of new entry, bargaining power of customers, and threat of substitutes. All 4 of these things have a synergetic effect, and their influence determines the competitiveness within the industry. If the industry is not, as competitive, there's a lot of people coming into the industry. That may mean that the industry is going to have high growth and may be a good potential investment. For the bargaining power of suppliers, if they can change their prices and the demand doesn't change, that shows that the suppliers, all the companies, they have a lot of say in the market and are able to change their prices because demand's inelastic. So on the opposite side, if customers, there's a huge buyer concentration, a lot of buyers in the economy, and in the industry. That may mean that they have a lot of power to determine where the industry goes. So they can determine if their demand decreases, firms may have to lower prices to compensate for that. And then also, the threat of substitutes. How many different companies are there trying to provide the same thing in the industry? You can think of, the shoe industry, like, there's Nike, Adidas, 10, 20 different brands, all trying to provide the same substitute, the same type product, but, they each have their own competitive advantage. And so, analyzing, using Porter's 5 forces to analyze the economy, that's a really important tool to see, is it an industry that is saturated and approaching efficiency, or is it something that you see has a lot of growth in the future because either, there's more people trying to come in, or there's certain firms that are coming in that are presenting competitive advantages. So that's, in analyzing the industry, you want to use these 5 things. All right, so say you did that, right? Say you used the top-down approach, you used Porter's 5 forces to analyze an industry, and you found that the beverage industry is going to, be hot in the future and it's going to grow based off your analysis. So you choose the beverage industry of the industries within the consumer staples sector, and then it takes you to the next page where you can find investments within this sector, within the industry. And there are thousands of investments that you can choose from. So how do you choose, which investment do you choose? Or which company do you choose to invest in? How do you know what to do? And that's where security screening comes in. And this is probably and arguably the most important part of investing, because this is where it takes investing and it changes it from a science into an art. This is where it separates the good from the great. Because in security screenings, it's all subjective, and you perform your own analysis on it. You could generalize the analysis of security screening into 2 main things. Primarily quantitative screening analysis and qualitative screening analysis. Quantitative is like analyzing financial statements and performing valuation strategies. That's where the fundamental and technical analysis comes in, discounted cash flow analysis. All these really important and intricate ways to figure out the number sides of the company. That's quantitative screening analysis. And this is what we're going to go over a lot as the meetings continue, because this is the heart of investing, and this is really what you have to nail down if you want to try to find out whether the investment is worthwhile. And then there's also the qualitative side, which is equally as important, because it's it's the intangibles of the company. It's the management team and culture and the competitive advantage that it offers, how you feel about the company in general. How's its goodwill, the brand name, the loyalty, the reputation of the company. All these things matter in terms of whether the company is going to grow or not. If you look at Chipotle, for example, they have a great management team culture. They have a very specific model of what they want to do and what they want to achieve. It's a food with integrity. That's their concept. And everything they do is to achieve that goal. They don't ever sacrifice the quality of their ingredients to try to lower prices. And that's really admirable of the company, and that's why I really like the company, because the management team is they have a model, they have an idea, and that's what they're going after, and that's what you want to see. You want to see you want to see a management team that has a very specific idea of what they want the company to be and trying to go after that. You see a management team that's all over the place. CEOs are coming in and out. CFOs are coming in and out. They're not keeping up with their promises after year to year. Then that may be an indication of mismanagement. And you can find all this stuff on the quarterly and annual reports and SEC filings. And SEC filings is a whole other topic, which we're going to have a whole day on that, because it is a monster to tackle. But this is where you find everything. This is where all the information is, and everything lies. So anyway, say you did your security screening. You applied a bunch of security screening techniques, and you performed your fundamental and technical analysis, performed discounted cash flow cash flow analysis on your companies that you're thinking about. You looked at the SEC filings, you looked at the management teams, you looked at, get a feel of the company, and then you determined that Coca-Cola was the best company that you thought was going to improve and grow in the future. We all know Coca-Cola. Its ticker symbol is KO. And so, let's say you chose Coca-Cola. This is on Fidelity again, and you choose Coca-Cola, and you could see all this information about Coca-Cola. You could look at its performance over the past year, or day, week, month, year, 10 years since its establishment. And then you have a whole bunch of other things you could look at, like you see the SEC filings, its financial statements, the ownership, like I said, whether it provides dividends, its earnings, key statistics and financial ratios, the research reports the analyst posts, and a bunch of other stuff. And so this is any Yahoo Finance, Google Finance, Morningstar, E-Trade, Fidelity, there's a lot of places you can look at this stuff and get information. My favorite is the Wall Street Journal, but everyone has their own. So anyway, and it's cool to think about. The reason why I chose Coke as an example is because everyone knows Coca-Cola, the company, and it's cool to think about that every time you buy a Coke, you're contributing to their revenue, which could potentially contribute to their increase in stock price. So in some strange, twisted way, you could be getting that Coke for free. Anyway, yeah. So you do your security screening. And you do your processes, and you can choose a certain company within a certain sector, within a certain industry, based off the macro analysis that you did. So it's all, as I said, the subset of subset of subsets within subsets. And it's a really logical way to think about it because. And it's a nice way because it takes a really complicated topic like investing, and it is, but it takes it and it simplifies it in a process where that you think you could tackle, and you think that it's not as crazy as you thought it was. And a lot of people use the top-down approach. So sure, you got an individual security, but that's only one investment. So how do you develop a portfolio? Well, essentially, you repeat the top-down process, the top-down approach, to construct a portfolio. And you can do this to find a whole range of investments that you want, that you think are going to outperform the market, or that you think are good for your portfolio. But the thing is, you need to make sure that, like everyone says this, you need to make sure that in order to have a successful portfolio, it has to be diversified. You don't want to put all your eggs in one basket. And ideally, you want to diversify across asset classes, right? So you want to be in equities, you want to be in fixed income, you want to have some cash, you want to have some alternative investments with REITs and tips for inflation protection, and you want to have a very diversified portfolio across all asset classes, and then within the equity asset class across all sectors and industries of the economy. And so that's the ideal portfolio in order to eliminate idiosyncratic risk. And unfortunately, you can't eliminate systematic risk because if the economy's going to shit, it's most likely that your portfolio is going to go to shit too. And you can't do anything really about that. So ideally, you want to have a globally diversified portfolio, like I said. You don't want to be just in the U.S. You want to be the entire world, because the U.S. isn't the only place that matters. And more importantly, the world's getting more interconnected. It's with the efficiency and quickness of communication. It's really important to be diversified across the entire globe. But for us, in the context of YUDI, we're going to be mainly focusing on the U.S. equity. And so what that means for us is that we're going to be diversifying across the sectors and industries of the U.S. stock market. And as you can see, it's like all the sectors I showed before, like here are, asset allocations of those sectors. And this is one example of a diversified portfolio of the U.S. economy, and U.S. sectors and industries. The good thing, though, And the reason why, not necessarily having a globally diversified portfolio matters that much right now is because there's a general 110 rule where you subtract your age from 110, and that's how much you should be invested in equity. And so for most of us, that's subtract around 20. Our portfolio should contain 90% equities anyway. And the fact that we can invest in ETFs gives us pretty good access to all the alternative investments anyway. So it's not like we're not losing that much out by not having the ability to invest in a globally diversified portfolio. In terms of diversification, it's also important to note that you don't want to only diversify across the industries and sectors of the economy, but then within each investment, this is part of the screening process, you want to determine, you want to diversify across small cap and large cap. Small cap stocks are typically less than 1 billion in market value, and large cap are greater than 5 billion typically. So people debate that range, and it's really up to your interpretation. But large cap stocks, it's like Apple, Chipotle, there's a bunch of them, Walmart. And then also you want to diversify across growth and value stocks. Growth stocks typically have very high multiples because people are willing to pay more for the stock because they think that the high growth is what's warranting the high price. They think that they're going to make that much money because of the explosive growth potential it has. Value stocks are more of, usually have lower multiples, and you buy them because they're on sale. Their intrinsic value is worth more than the price reflects, so that's why you buy a value stock. That's what Warren Buffett loves, and those are stocks I like as well. Because for me, I like to look at the long-term investing, but finding companies that have great intrinsic value. Because the short term there's so much fluctuation in the short term because of news and everything, and news is unpredictable, so it's so hard to predict the very short term. But if you perform very sound fundamental analysis and you do your homework and the grunt work, you can find companies that in the management team and all that qualitative, quantitative analysis I was saying. If you do all that stuff, you can find companies that are intrinsically great companies, and so you're buying them for the long run. Doesn't matter what happens in the short term, but in the long term, it's eventually going to go all the way up. That's the idea of a value stock. So really, that's today. That ends today's meeting. But there's a couple slides more just to explain some stuff. But point was, top-down approach. Wanted to introduce it because not only is it an outline for how to evaluate a stock and to find a good investment, but it's also an outline for you. What we're going to be doing and how we're going to tackle the investment process, because it's a very logical process, like I said, and it works well. And if you do it right, it works well. I should mention that, because it's only as good as your inputs. If you have bad inputs, garbage in, garbage out. If you don't do it, put in the right inputs, you're not going to get anything out of it. And so our goal is to teach you, throughout these meetings, how to find the right inputs, how to determine the right inputs, so that you can, find companies that actually are going to perform well. So like I said, that's, we're focusing on the security screening and security selection aspect, because that's really the heart of investing, and that's where it matters. And that's what separates the good from the great. Our next meeting is the 13th of November. We have Barbera's coming on the 18th at 8 p.m. We'll let you know about the location of it. I think it's at LC, right? Yeah, LC 101. Yeah, LC 101. We'll send an email. Then we have Keith Suzai from Goldman Sachs. He's going to give a talk on investment banking. He's a great guy. I did the externship for him, and he loves to help people out. So, really recommend you come to these lectures, because these are very prominent people in the fields, and maybe you could talk to them and just say hi, introduce yourself, establish a connection. One other last point that I want to make is, reading about the economy and investing is almost as important as doing your own research. There's a lot of books out there, but these are some of the best ones we thought. I really recommend The Intelligent Investor by Benjamin Graham. He's considered the father of value investing, and he was Warren Buffett's mentor. So it's a really good book. I'm almost done with it. It's really long, but and then there are a few others. And then mentioned the YUDI competition. YUDI competition starts second semester. It's going to be a really fun time. You got to pick your own team though. It's 3 to 5 people, and if you win, there's going to be some sort of Wall Street executive shadowing that we're going to offer, and as well as cash prize. And so it's networking opportunities and cash prize. So it should be a fun time and make it a little competitive. And the point of it is, to take what we learned through the meetings and through the guest lectures, and then to apply it to your portfolio that you guys manage. This is our official partner. You want to? Yeah, that's fine. He's coming to speak as well in early January.
So just quick, with the competition, we're going to be doing it through the platform of Wall Street Survivor. They have a lot of education materials that you guys can use, and they're going to have subsidized materials and free materials for members of the group. And so we're really looking forward to working with them. And then just lastly, we're going to send a panelist email for more information on new available positions, board positions for this semester and next semester. So keep an eye out for that. Questions and comments? You guys have any questions? And then additionally, make sure you guys scan your QR codes or make them if you haven't made them yet, and talk to Will, who will be outside the door.
That's the way we're going to attract attendance. So
yeah, because so we appreciate you guys doing that. It's just a quick way for us, and for the rest of the semester and going forward, you guys can keep the same one. So awesome. Thanks guys for coming. Appreciate it.